If you look at the addressable market for what it takes place on the banking system and just assume that half of this ends up on the blockchain, then that's really worth $3.8 trillion of captured value on Ethereum. And then if you think about like Swift and Visa, which is about 450 billion a year, and assume, there's a gas fee per transaction, and then what it means to essentially network revenue, you apply, I think, a conservative 30 multiple to that, you get roughly 3 trillion of value. So the idea is that if you add those two pieces together, Ethereum should be close to $60,000.
Ethereum is on track to capture trillions in banking flows and settlement revenues. Once that value is priced in, Ethereum will shoot to $60,000. That's the latest message from Tom Lee, co-founder and head of research at Fundstrat. Ethereum's position in the crypto market has often been framed as secondary to Bitcoin. But Tom Lee's analysis pushes back against that view. He argues that Ethereum is not only complementary to Bitcoin, but may even eventually outpace it in terms of financial utility. If blockchain becomes the backbone of global settlement, Ethereum is the network most directly positioned to capture that flow. Banks, payment processors, and tokenized assets represent trillions of dollars in value. If even half of that activity transitions to Ethereum, the implied market capitalization jumps by several trillion, which in turn drives a price closer to $60,000 per coin. Make sure to stick around until the end of the video, as Tom Lee not only explains the math behind his $60,000 Ethereum target, but also outlines why institutional adoption, regulatory shifts, and real-world applications could make this moment a once-in-a-generation opportunity.
I've essentially had one job my entire career, which is researching markets. And I first started off at Kidder Peabody, following the technology sector, wireless actually, and that went from 1993 to 2007. What I learned during those days was a few things. The wireless industry was in its infancy. There were only 37 million cell phones in the world at the time. Today there's around 8 billion, so it's an industry that grew exponentially. But I was surprised at how skeptical clients were about wireless as a technology, because at the time, long distance and local telephones were really the big business of the telecom industry, and wireless was considered basically something that would become free because it's just a glorified cordless phone. So I knew as a young person that a portfolio manager in their 40s is not the person that really understands disruption in technology, because they're essentially an incumbent. And then, I became chief strategist for JP Morgan, did that until 2014 before starting Fundstrat. And at the time, Fundstrat was created to be what I would consider the first Wall Street firm to try to democratize institutional research. We wanted to make what we were doing for hedge funds and large managers available to the public. And then around 2017 or so, I started to see headlines that Bitcoin had crossed $1,000. And I remembered many conversations at JP Morgan about Bitcoin from our FX team. And at the time it was under 100. And we had many conversations because there was this idea that this digital currency could become recognized as a form of money. But at JP Morgan, they took a very dim view of it, because they said it was really the purview of drug dealers and, smugglers. But I know that in my 20-year career, at the time 20 years, that I've never seen anything go from under 100 to 1,000 and have a network value of 10 billion. That wasn't something I had to study. So we studied it, and I realized that while I didn't fully understand how to justify storing value on a blockchain with proof of work, that we could explain more than 90% of the rise of Bitcoin from 2010 to 2017 by just looking at two variables: number of wallets and activity per wallet. And because of that, we could model what Bitcoin could look like in the future. So that was my first, I guess, journey. And so we published our first white paper when Bitcoin was under 1,000. And we said that if someone viewed us as a substitute for gold and it got only a 5% share at the time, you would get to $25,000 value for Bitcoin. And so that was our projection for by 2022. And by the time 2022 came around, of course, Bitcoin was around 25,000. So
that's great, Tom. And, for the listeners who don't know, I had the privilege of also learning a lot from Tom as well. And I also had the privilege of doing a great panel with you at Ethereum New York recently. And, we didn't get to talk as much on stage. There's a lot of things to address, and I'm glad we can do this. Can we talk about, you're doing some interesting stuff. We're talking about Bitcoin. You're doing some interesting stuff with Ethereum. Can we talk about the macro opportunity for Ethereum?
So for much of the work, and Sean and David, you guys know that from 2017 up until 2025, our focus on crypto has been the idea that, Bitcoin had a very clear place in someone's portfolio because of its not only proven size and stability, but it really is as a way to store value. And then when we thought about how people should allocate crypto outside of that, there were many projects, whether it was Solana, Sui, or the many things that you guys write about. But beginning this year, we started to take another hard look at Ethereum. And the reason for that is that I think that the regulatory picture is moving in a way this year in the United States in a favorable way that is getting Wall Street to take crypto and blockchain pretty seriously. And of course, the killer app or the ChatGPT moment really was stablecoins and Circle's IPO. But following on that was the Genius Act and then the SEC's Project Crypto. And the reason I think this favors Ethereum is many, but foremost, when we look at the projects that are taking place for Wall Street to tokenize assets, whether it's dollars or other assets, the majority of this is taking place on Ethereum. But maybe more importantly, I think, people have to take a step back and realize that what's happening on Wall Street in 2025 is it's maybe more akin to what happened in 1971. And in 1971 was the year the US dollar depegged from gold. So the US went off the gold standard. And while gold was a beneficiary of that, many people bought gold, it was actually the idea that Wall Street began to innovate because suddenly you had a fiat dollar that you now had to sort of move around and create rails for that was not backed by gold. So the real winner there was Wall Street. Well, in 2025, this kind of innovation, blockchain solves a lot of problems and speeds a lot of things. Wall Street moving onto crypto rails, I think, is like a 1971 moment for Ethereum. So I think it's creating enormous opportunities to move a lot of things onto the blockchain. And Ethereum won't be just the only winner, but it's one of the primary winners. And from an institutional adoption perspective, I've heard a lot of people talk about this. Bitcoin's already become very institutional. When I talk to investors and I do meetings, they understand how to sort of understand how to model or even think about future value for Bitcoin. And it is in a lot of people's portfolios. Ethereum is so under-owned that it's more like Bitcoin in 2017. I don't think Ethereum is actually viewed as an institutional asset today. So I think it's so early, and that's why I think there's a bigger opportunity.
Tom Lee's credibility comes from decades of recognizing disruption before the market caught on. In the 1990s, he watched wireless technology evolve from a clunky cordless phone upgrade into the backbone of global communication, scaling from tens of millions of users to billions. Established players dismissed it, but exponential adoption could not be stopped. He applied the same thinking to Bitcoin, tracking simple yet powerful variables like wallet growth and transaction activity. Those models explained Bitcoin's climb from under $100 to nearly $69,000 in just over a decade. Now, Lee sees Ethereum stepping onto that same curve. In his view, 2025 marks the kind of structural reset that reshaped Wall Street in 1971. This time, the catalysts are stablecoins, tokenized assets, and enterprise blockchain adoption. And Ethereum is the settlement layer connecting them all. While Bitcoin has matured into the accepted store of value, Ethereum remains overlooked and underallocated, especially by large institutions. That gap between adoption potential and market recognition creates one of the most asymmetric investment opportunities available today.
You have a price target for ETH, which I might just have you explain how you get to that. I think it's 60,000.
Yeah, no, that's not near term. So I don't want to be held to like someone saying on December 31 it didn't achieve.
That wasn't for next week, Tom, because I thought that was one of those next week targets you do.
But yes, and actually, I'm citing work when we did that analysis for ETH. It was some research done by Mosaics and some other folks, and what they wanted to do was, again, approach it as if this is a 1971 moment. And so they wanted to think about the value of Ethereum as both a payment rails, okay, and then capturing a portion of payment volumes. And so I think both are kind of additive concepts. And so their idea is that if you look at the addressable market for what it takes place on the banking system, and just assume that half of this ends up on the blockchain, then that's really worth $3.8 trillion of captured value on Ethereum. And then if you think about like Swift and Visa, okay, which is about $450 billion a year, and assume there's a gas fee per transaction, and then what it means to essentially network revenue. You apply, I think, a conservative 30 multiple to that, you get roughly $3 trillion of value. So the idea is that if you add those two pieces together, Ethereum should be close to $60,000 per unit. And again, that's that's an 18x roughly from here.
How should the audience go about thinking about the trade-offs of exposure, between treasury companies and other options like spot or ETFs, just broadly?
One, there's nothing wrong with someone wanting to own an ETF to get exposure, because then they're going to own, without much tracking error, kind of direct exposure to Ethereum, just like the Bitcoin ETFs give you direct exposure to Bitcoin. But if you look at the Bitcoin treasury space, MicroStrategy is larger than the largest Bitcoin ETF. So there's actually more investors who are preferring to own Bitcoin through MicroStrategy than through Bitcoin. And I think it's for a logical reason, which is that a crypto treasury isn't just giving you a static exposure to Ethereum. What they're doing is they are giving you exposure to someone who is trying to grow your Ethereum holdings per share. And MicroStrategy is a great example. When they went to pivot to their Bitcoin strategy in August 2020, MicroStrategy had roughly a $13 stock price, and it's gone to 400, well, let's say 30x from that point in the last 5 years. During that time, Bitcoin was 11,000, and now it's about 120,000. So it's about an 11x. That means that MicroStrategy has grown its holdings of Bitcoin per share, while like a Bitcoin ETF would have kept you constant. So in that same 5-year period, you'd made 11x owning a Bitcoin ETF, but you did far better because of his treasury strategy. And that treasury strategy is using and taking advantage of the liquidity of his stock and the volatility of his stock so that he can acquire more Bitcoin per share. And that's what Michael Saylor's strategy has successfully done, because he went from having, a dollar or two of Bitcoin per share to 227 today. So a massive, massive increase. The majority of the time, someone's coming and looking at crypto treasuries with a really skeptical eye. I think many investors who've owned MicroStrategy have done really well with it, but MicroStrategy is not as widely owned as you think, even though it is one of the largest stocks in the market today. And the reason many people don't understand it is that we already have a very big universe of people that don't believe in crypto. I mean, whether you look at any survey, the Bank of America's latest survey, 75% of institutional investors have zero exposure to crypto. Zero. So that's 3/4 of the universe. And when they look at crypto treasuries, they think that these are inferior to holding the underlying token. And so a lot of the education that we've done in our meetings is to explain that, and I can just cite some numbers from BitMine's presentation. The difference in a crypto treasury versus holding Ethereum is simply the fact that we are growing your Ethereum holdings per share, because on July 8th, when we closed the pivot to the Ethereum treasury, there was only $4 of Ethereum held per share. And then on July 27th, which is about a month ago, when we published that update and put it in a presentation, there was $23 of Ethereum per share. So the amount of ETH held per share went up by like 6 times. And, 8 times, 9 times. And so it really shows you that there is a really big change in how much, what I call the velocity or the accretion held of ETH per share that comes from a properly executed treasury strategy.
The strength of Tom Lee's forecast comes from how he builds it. He doesn't rely on hype or speculative storytelling, but instead approaches Ethereum the way an equity analyst would evaluate a disruptive tech company. The first step is banking. Trillions of dollars move through settlement systems every year, and if even half of that migrates to blockchain rails, Ethereum's capture alone lands in multi-trillion-dollar territory. The next step is payments. Networks like Visa, MasterCard, and Swift handle hundreds of billions annually. Apply conservative multiples to those flows, and the implied valuation for Ethereum justifies a 5-figure price tag. What makes this especially convincing is the convergence of macro conditions and institutional behavior. Regulation is improving, with stablecoins and on-chain settlement gaining legitimacy. Wall Street firms that once dismissed crypto are piloting tokenization projects, most of them on Ethereum. And while Bitcoin already enjoys deep institutional penetration, Ethereum is still relatively untouched. 3/4 of institutional investors report zero crypto exposure. That gap is the growth window. Lee also highlights crypto-native treasuries, corporate structures designed not just to hold Ethereum, but to compound it through staking, yield, and volatility strategies. The model mirrors MicroStrategy's approach to Bitcoin, multiplying holdings per share over time. Taken together, Ethereum is positioning itself as the financial infrastructure of the future. If Lee's framework is even partly correct, today's prices will seem trivial in hindsight, and the next 5 years may prove to be the most important window for long-term investors. Do you see Ethereum becoming the backbone of global finance, or will Bitcoin continue to dominate? Share your thoughts in the comments below. If you want to stay most up to date on the crypto and Bitcoin world, subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis, trusted by over 90,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it gave you some value. I'll see you all at the next one, and as always, all the best.